Welcome! Today we're cracking open the playbook of the entire economy by looking at market structures. So what are they? Well, you can think of them as the hidden rules of the game, the things that decide how businesses compete, how prices get set, and really why some companies have a ton of power while others have basically none. Okay, let's dive right in.
Have you ever wondered about something like this? I mean, why is the market for a basic thing like wheat so different from the market for, say, a patented new drug? The answer, it's all about the structure of the market they operate in. And that's exactly what we're going to break down, piece by piece. So here's our game plan. We're going to take a trip across the whole spectrum of competition. We'll start with the theoretical ideal, what's called perfect competition, then swing to its polar opposite, the powerful monopoly. After that, we'll get into the messy, real-world middle ground where most companies actually live. That's monopolistic competition and the oligopoly. All right, let's get started.
First up, perfect competition. Now I know what you're thinking. Perfect? That sounds kind of unrealistic, right? And you're not wrong. This is a theoretical model, but it is super important because it's the benchmark. It's like the perfect yardstick we use to measure all other real-world markets against.
So what does this perfect world look like? Okay, imagine a market with just tons and tons of sellers, and they're all selling the exact same identical thing, like a specific grade of wheat. And in this world, anyone can jump in and start selling, no problem. Because of all that, no single firm has any power to set the price. They're what we call price takers. They just have to accept whatever the going market price is.
To make this real, just think about the stock market. Let's say you own a few shares of a huge company, and you decide to sell them. You can't just go and demand a higher price, right? Nope, you have to sell it whatever the market price is at that very second. You, as that trader, are a perfect real-world example of a price taker.
And here's the really critical outcome of all this. In the long run, in a perfectly competitive market, firms don't make any extra juicy profits. Why not? Well, imagine a new suburb, and one car wash opens up and starts making a ton of money. That profit is like a giant flashing sign, isn't it? So what happens? You got it. Someone else opens a car wash right down the street. New businesses will keep jumping in until all those extra profits are competed away, bringing everyone down to basically zero economic profit.
Okay, now let's do a 180 and jump to the complete opposite end of the spectrum. We're going from a world with countless competitors to a world with just one. We're talking about a monopoly.
You can see the huge shift in power right here, and it's all about the shape of the demand curve. For that firm in perfect competition, its demand curve is a flat, horizontal line. This means if they charge just 1 penny more than everyone else, nobody buys from them. But a monopolist, they are the market. Their demand curve is the whole market's demand curve. It slopes downward. This gives them the power to choose their price. They aren't price takers, they are price makers.
Now this price-making power, it comes at a cost to society, and economists have a name for it. Deadweight loss. It sounds a little technical, I know, but the idea is actually pretty simple. It's the value that is lost to everybody when a monopoly makes something artificially scarce just to jack up the price. It's all the transactions that should have happened, but now won't.
This bridge example makes it crystal clear. Imagine a company owns the only bridge into a city. To make the most money, they could charge a really, really high toll. Sure, the company makes a killing, but that crazy high price means some people who would have happily paid a fair price to cross, now just won't make the trip. That lost value, the value of those trips that never happened, that is the deadweight loss. And monopolists can get even smarter with their pricing power. They use a strategy called price discrimination. The classic example here is airlines. They know a business traveler has to get to that meeting, so their demand is inelastic. They're not very sensitive to price. They'll pay what it takes. But a family going on vacation, they're flexible. Their demand is elastic. They're super price sensitive. So airlines use things like Saturday night stay requirements to sort us out and charge us wildly different prices for the exact same seat on the same plane.
Okay, so we've seen the two extremes, right? Perfect competition on one side, monopoly on the other.
But what about that messy middle, where most businesses we interact with every day actually operate? Let's dive into our first hybrid, monopolistic competition.
This one is a really interesting mix. See, like perfect competition, you have a lot of different firms, and it's pretty easy for a new one to get started. But, and this is the big but, like a monopoly, each firm sells a product that's slightly different. They're competing on their brand, their quality, or maybe just their location. And that little bit of difference gives them a little bit of power to set their own price.
And coffee shops are the perfect example. You know, your favorite local cafe can probably charge a little more than the place down the street because you love their specific coffee blend, or you just like the vibe. In a way, they have a little mini monopoly on their unique brand. But if they raise their prices too much, what do? You just walk 2 blocks to the next one, right? There are plenty of other good options.
So what's the long-term result here? Well, these businesses aren't quite as efficient as they could be. Think about the market for designer sneakers. Companies spend a fortune on marketing and advertising just to convince you that their shoe is special. All that spending means they aren't producing at the absolute lowest cost possible. Economists say they operate with excess capacity. All that means is they could make more shoes at a lower average cost, but they don't because their whole game is built on branding and differentiation, not just rock-bottom efficiency.
All right, that brings us to our final and maybe the most intense market structure of all, the oligopoly. This is where an entire industry is dominated by just a handful of massive firms. If there's only one word you remember for oligopoly, let it be this one: interdependence. In this kind of market, every single move a company makes about price, about advertising, about a new product is made while constantly looking over its shoulder to see what its rivals will do. It's like a high-stakes chess match.
And the breakfast cereal aisle is the perfect battlefield for this. Seriously, if Kellogg's puts Frosted Flakes on sale, you can bet that the folks over at General Mills are in a meeting that same day trying to figure out how to respond with Cheerios. They can't ignore each other. They absolutely cannot.
This interdependence creates this really fascinating tension, this constant push and pull. On one hand, these few companies have a huge incentive to collude, to secretly work together, act like one big monopoly, and keep prices high for all of us. But at the exact same time, each individual company has an equally powerful incentive to cheat on that agreement so it can grab a bigger piece of the pie for itself.
And you can't find a better real-world example of this than OPEC, the big oil cartel. The member countries all get together and agree, okay, let's limit how much oil we produce to keep global prices high. That's the collusion. But then what happens? Individual countries are always tempted to secretly pump a little extra oil on the side to make more money for themselves. That's the competition. And of course, if everybody cheats, the price collapses and the whole deal falls apart. It's the prisoner's dilemma on a global scale.
So there you have it. From the farmer's market to the gas station, from your smartphone to your morning coffee, these structures are playing out all around us, all the time. So the next time you go to buy something, just think about it for a second. What are the rules of the game being played here? Which market are you in, and who really holds the power?